Hi, it's John Kelly. In this module, we are going to discuss modifications to the audit report. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, there are 4 types of modifications, and they're now called modifications. They used to be called qualifications, but because we called 2 of the modified audit reports qualified, they're now all referred to as modified audit reports. And there are 2 general types, a misstatement due to GAAP or the financial framework we're following, and a problem with scope. And in all cases, it has to be material. If it wasn't material, we wouldn't bother qualifying the audit report. But one of these 4 types of problems is material. And then the distinguishing factor, other than is it the framework or scope of the audit that's a problem, is the problem pervasive or not? And so if it's not pervasive, you get a qualified audit opinion for the problem with the framework. And not pervasive means, and I say one thing wrong, but is it something that you can clearly describe in the audit report what's wrong so the user will clearly understand, or is it a pervasive problem that everything's wrong? And so an example of one thing wrong, valuation of inventory, we know it's wrong, and we will describe that in rather too much detail in our audit opinion. Or is there a missing note? If there's a missing note, we will effectively write the missing note in our audit opinion. Scope could also be a problem. One thing can't be audited, and the classic example there is we were appointed auditor late in the year and opening inventory was not observed. There's no way around that. We will have to qualify in the first year of our audit because we did not do procedures to observe the existence of opening inventory. Material and pervasive with respect to GAAP, adverse, we know it's wrong. Everything in the financial statements is wrong. We have a material subsidiary. It's not consolidated. The financial statements are just wrong. And it would be far too complicated, and the users probably wouldn't understand if we tried to write in the audit report everything that was wrong, so we give an adverse opinion. If it's material and pervasive with respect to scope, it's called a disclaimer. There's a whole bunch of stuff we can't audit. There's an unaudited subsidiary, for instance, that's consolidated, and we just go, well, we got no idea. So those are the 4 types. 2 are called qualified, adverse, and disclaimer. Now here is an overview of the opinion changes, and this is very picky, so you have to be very, very careful. So you need to refer to both the appendices and examples and to the standard to make sure that as you are writing your qualified opinion or modified opinion, that you've got it right. But this is a sort of an overview of the changes. There is a sentence where we say that we plan and perform the audit, and that sentence is unchanged for all 3 except for a disclaimer where we provide a reference to the basis for the disclaimer. We say this is why we've disclaimed our opinion. And there's a place where we go, we believe the work we've done provides a basis for our opinion. We will change that to a basis for our qualified or adverse opinion. And if we disclaim, we drop that sentence entirely because we say we just have no idea. There will be a basis of opinion paragraph, basis for qualified opinion. So that will be inserted and will describe what the problem was. And it'll either be a basis for a qualified opinion, a basis for an adverse opinion, or a basis for a disclaimer of opinion. Then the header of the opinion paragraph, which would normally just be opinion, is replaced with qualified or adverse or disclaimer of opinion. And if we are qualified, we've got the one where there's sort of only one problem. We would say except for the effects of, and then we would refer to the basis for qualified opinion paragraph where the problem is described. If it's a scope qualification, we will say except for the possible effects, because Our scope was limited. We couldn't observe opening inventory. It might be right, it might be wrong, we don't know. So it could be that there is no effect, so that's why we say possible effect. If it's adverse, the statements are not consolidated, every number is wrong, we would say, in our opinion, the financial statements do not present fairly. We know they're completely wrong. If it's a disclaimer for scope, we go, we have no basis and we express no opinion. We have no basis to give any kind of opinion at all, so we're not going to give you any kind of assurance of any kind. We say we have no basis. We do not express an opinion. And as I said, the wording is really, really picky, and you've got to be very careful, and you're saying some mean things about a client, so be very careful that you write it exactly correctly and refer to both the standards and the appendices. This is also a place where we're going to have an unusual situation, so we need to make sure that our documentation of what we think the problem is and why we think there's a problem is pretty clear. And be sure your client knows. Don't surprise a client with a suddenly qualified or modified audit opinion. And the other thing you might do, particularly if you have a disclaimer or adverse opinion, you might want to seek legal advice because your client could become quite angry with you. So you might want to talk to a lawyer before you went ahead and did this to make sure that you're doing it exactly the right way. And again, there are too many examples. There's the URL, Reporting Implications of the New Auditing and Accounting Standards. This is a Canadian document, 252 pages, but there are many, many examples of modified audit opinions. So if you're struggling to find an example that's relevant to your circumstances, perhaps in the 252 pages, as a matter of fact, almost certainly in the 252 pages, they might have an example for you. There's a lot of examples. Now, GAAP modifications are infrequent. Qualified for GAAP, if there's missing disclosure, well, you're going to provide the note that's missing right in your audit opinion, so your client's probably going to go, okay, we'll put it in the financial statements if you're going to put it in the opinion. Or if there's a valuation problem, it's going to be so specifically described that the client's normally just going to go, well, okay, I give up. If you're going to write such a mean report, I'm just going to fix it. Adverse, the wording is terribly, terribly negative. And because of that, it's very, very infrequent to get an adverse opinion where we say we know the financial statements are wrong. Ones that are more common are scope qualifications. Opening inventory, that's a classic, though we're not supposed to just casually qualify our audit opinions if we could get around it somehow. So if you're appointed auditor for this year in January of this year, and you know you're going to have a problem with opening inventory, you should say to the client, well, we need to count inventory right now. We need to count at the end of January or the end of February. We're going to roll it back to December so that we will be able to give an unmodified opinion on this year because we've checked out opening inventory. And we're also going to have to check all the other opening balances. We have to check cash, we have to check receivables, payables, fixed assets, all that stuff. That's normally possible to do. Normally the only thing you can't do is go back and observe inventory. The other one that's common, and probably more common than it should be, is cash receipts of an NPO, completeness of revenue. And I don't quite understand that one. We worry about cash receipts in a not-for-profit. Why don't we worry about that in other organizations that have tremendous amount of cash receipts? MGM Hotels International, lots and lots of cash, gambling, casino floor, slot machines, all that kind of stuff. They get a clean audit opinion. Why can't a not-for-profit organization that has cash receipts get a clean audit opinion? And the answer is internal control. The client should be able to and can have good internal control over cash receipts. And if they do, a not-for-profit organization should have every expectation of receiving an unmodified audit opinion. So the auditor should try to do that. Now, certainly there are some NPO clients that just don't spend enough time and effort on internal control over revenue, and they're going to get a qualified opinion. So concerns that we have, the wording is very, very picky. Refer to the appendix, refer to the standard, and double check that you've got the required documentation. Now, the things that makes this 705 revised are really very few in terms of the requirements. The requirements change very little. The paragraphs have been reordered a bit. Arguably, it's a bit clearer the way the section is now structured. So not much change in the section, but big changes in the opinion format, even though kind of the rules and the concept of how the opinion is qualified are the same. Lots of opinion format changes due to 700R. So, thanks for listening.